If you look at the US economy right now, you might feel a strange disconnect. There is no massive stock market crash making headlines, but beneath the surface, there is a quiet, steady financial pressure weighing on millions of Americans. You feel it at the grocery store, where the cost of living remains stubbornly high. You feel it when you look at credit card statements, or when you try to secure a mortgage with borrowing costs that haven't been this elevated in years. Meanwhile, national debt continues to pile up in the background. It brings up a very logical question. If households are feeling this much strain, why doesn't the Federal Reserve step in, cut interest rates, and offer some relief? The truth is, the Federal Reserve isn't holding back to be cruel. They are physically trapped by their own legal rulebook. Right now, they cannot make a single move without risking a disaster. The human decision-makers at the central bank are bound by something called the dual mandate. Congress gave the Fed two primary, legally required jobs, and in times like these, those two jobs are deeply at odds with one another. The first job is price stability. This requires the Fed to fight inflation and keep the overall cost of living predictable and under control for everyday citizens. The second job is maximum employment. This means they are equally responsible for protecting American jobs and preventing massive waves of layoffs across the country. Steering the 2026 economy creates a direct conflict. The latest data reveals that to satisfy one legal mandate, the Fed would have to ignore the other. This chart shows the U.S. inflation rate over the last few years. While the severe spikes of the early 2020s are behind us, the latest July data shows inflation sitting flat at around 3.4%. It simply means prices are rising more slowly, not that they are falling. If your weekly grocery bill jumped from $150 up to $200 over the past 3 years, lower inflation today doesn't bring that bill back down. The receipt stays frozen at $200. Those higher price levels remain baked into the economy. That creates relentless financial pressure on everyday households, even when the official inflation statistics look like they are improving. If you look strictly at this inflation data, the Federal Reserve has no choice. To force prices to stabilize, they have to keep interest rates high to aggressively cool down the economy. But then, the Bureau of Labor Statistics released a very different set of numbers. In July, the United States unexpectedly lost about 23,000 jobs. This chart tracks monthly job creation. See how the trend line suddenly dipped into the negative? At the same time, the overall unemployment rate ticked up to 4.1%, and previous month's job estimates were quietly revised downward. This is a warning sign. Keeping interest rates elevated makes borrowing expensive for businesses. Eventually, that heavy cost suffocates growth and forces companies to freeze their hiring or start laying people off. Based on the labor market, the Fed is facing intense pressure to cut rates immediately before these job losses snowball into a recession. It is a total policy collision: fight inflation or protect jobs. As the Federal Reserve hesitates, caught between these two mandates, the anxiety is spilling over into global financial markets, specifically into U.S. Treasury yields. This chart shows what the long-term bond market is doing. Yields are surging to 25-year highs. The 10-year Treasury yield recently neared 4.7%, and a recent 30-year Treasury auction produced a yield of approximately 5.216%. Why do those percentages matter? Because those yields dictate how much the Treasury Department has to pay to maintain the U.S. national debt. The government must continuously issue new debt to fund its operations. With yields at these levels, the interest payments on the national debt consume an increasing share of the budget. The consequences of the Fed's hesitation have moved beyond policy theory, directly driving up the cost of financing the entire American government. And all of this cascades down to the consumer level, hitting the housing market particularly hard. Because bond yields remain elevated, 30-year mortgage rates are stuck near 6.67%. This creates a lock-in effect. Existing homeowners refuse to sell because they don't want to lose the mortgage rates they secured years ago. At the same time, potential new buyers are entirely priced out by the expensive 6.67% financing. The stock market is facing its own pressure. When investors realize they can get high, relatively safe returns simply by buying government bonds, they are far less willing to risk their money on expensive equities. Everyday Americans are left as collateral damage in the Fed's dilemma, squeezed between an unaffordable housing market and increasingly volatile investments. This brings us to the most important financial lesson for August 2026. Stop building your financial plan around predicting the Federal Reserve's next move. Instead of asking what the central bank will do, you need to ask a better question. How resilient is my personal financial situation if interest rates simply stay exactly where they are? Focus on what you control. Find out exactly how much interest you're paying on credit cards and aggressively pay down that high-interest debt. And if you are building an emergency fund, prioritize holding cash for unexpected expenses instead of trying to invest every single dollar. True financial security doesn't come from waiting for a trapped central bank to lower rates. It comes from building a personal balance sheet that is strong enough to survive the uncertainty.